All right. So last week, what we did is we went through basically what is an IUL, like when would I use an IUL and who would an IUL be good for, kind of thing. So now where we left off is we need to go design an IUL. So the case design on an IUL is crucial because an IUL can be the smartest financial decision someone's ever made in their entire life, or the worst, depending on how it's set up. And what I see nowadays is IUL is a huge buzzword, and there's so many new agents that are coming out of the woodworks that are wanting to learn IULs, and they know how to spell it, but they don't exactly know like how to use it or how to structure it. And so like when I talk to a client, I tell them, I'm like, look, we met online. I assume I'm not the only person you're talking to. Here's what I would ask you. When you go get 2 or 3 other opinions, I want you to ask them, can I watch while you structure my case and watch people squirm? Because one, they either don't know how to do it. Listen, I was new once, right? I had to have a manager do my illustrations, but I studied and I learned really quick how to do them. And after doing 2 or 3, I was doing my own, you know? So it's not that difficult. So if they're that new that they don't know how to do it yet, either someone does all their work and they fully don't understand it, or they're doing something shady they don't want you to see. So one of my videos that went viral is I posted a video and I said, if you already have an IUL, then stop scrolling. This is for you. I said, there's a good chance your IUL is structured incorrectly. I can look at it in less than 10 seconds. I'll tell you if your policy is set up for maximum cash growth or maximum commission growth. Do you know which one you have? Well, that intrigued so many people. They're like, damn, how do I know? I bet. So they started calling me. They're sending me in their illustrations. Listen, y'all, I got one that was from F&G, and I asked them, is this anybody within my group? And they said no. So I took it because this person took a 32-year-old man that's perfectly healthy, and you know, his minimum death benefit should have been like 150, right? 200, something like that. It was an $800,000 level policy.
Oh my gosh.
The commission on it was like $27,000. And I was like, good Lord, man, are you that greedy? You're not okay with just making 10, you know?
Well, and I mean, the thing about that is it's like, did this guy say he really wants that much in coverage, or did you let him see the illustration of what it looks like to build?
Exactly. So, and that's the thing. Like, don't get me wrong. I've written plenty of level policies. I just hung up with the guy that has 10 daughters.
Holy smokes.
Holy
I
crap.
know. I was like, bro, I hope you at least got a dog that's a boy. Oh, you're like, that's estrogen nightmare over there. I don't know how you handle. Are they all on the same cycle? You just leave for that week? What happens?
Is he on some strong anti-anxiety meds?
Right. Jersey, clients, fine. Jersey, how old are you? 28, 24?
20, about to be 28 in 4 days.
You said we could go back and watch this again, right?
Yes, I'm going to send you a link. Yes,
Okay,
ma'am.
perfect. Because this is what I need, is how to structure it correctly.
We're going to do it. So Jersey, you're male, right? All original parts still installed. We'll just say you're in Kentucky, IUL, find, and we're going to use Path Setter. So one, a little tip. Hey, this is important. Do not ever write an Everlast on a minor. Everybody know that? Yes, no?
No, why?
Say that one more time.
You do not ever, if they're under 18, do not ever write Everlast. Everlast is their, do you guys also have Mutual of Omaha?
Yes.
Yeah.
Okay. So the IULE, that was the original Index Universal Life Express. So now everybody's coming out with one, right? Americo's is an Express product. Ethos, I helped design that one. It is an Express product. Even if you click cash, it's an Express product. It's issued today, you're paid tomorrow. That's an Express product. Everlast is their answer to the IULE with Mutual of Omaha. It's a great product if you want to have it issued quickly, get paid quickly. If you're a newer agent that doesn't really know how to structure these, that's a good place to start. You really can't go wrong. It's kind of going to be a blend of, cash with some good death benefit. But it is not meant for juveniles. What happens when you write a juvenile is it's going to trigger a phone interview. So if you write this on a juvenile, expect it to take a couple months. Versus if you write a juvenile on Path Setter, most of the time in the app, it pops up and says, like Americo, it says client's been approved. That's fairly new with the Wizard app. If y'all had that happen yet, you've seen it where they just pop up approved before you even finish the application. It's still kind of rare, but it happens.
No.
Yeah.
I've had them decline
I like
before
it
I
when it
finished the application.
You do what?
I've had them decline before I did the application.
Oh, yeah. First things first, we want to look at what we're solving for. You should always be solving for something, and it should always be revolving around accumulation. So with most carriers, you're looking for minimum death benefit, max accumulation, or just max accumulation. Technically, you could use this max accumulation. It just doesn't give you the option to show them income. I like to show them income. I think the presentation I do when it shows income is very powerful. If you don't show that, you're like, all right, you got $300,000 when you're 65. They can't process in their mind what that means. Like, how long is that going to last? How much of that should I take? How much am I going to get? When you do it this way, you can show them, here's what your guaranteed paycheck for life's going to be, kind of thing. Not guaranteed paycheck, you know what I mean? Let's see. So let's just say Jersey, 28, he's going to put in $1,000 a month. I always use $1,000. If right off the bat, you're asking the customer, hey, Heather, how much do you want to contribute to your policy? Right? They don't know what this is yet. So they don't know how to answer that question. So, I mean, I saw an agent once and she was like, well, how much do you want to put in the policy? And they were like, well, I don't know. What's like, how much do I need to put in it? And they were like, well, just whatever you want. Okay, but like, I don't know how much to do. Like, they don't know what to answer. They don't know what to say. So I just show them 1,000. I just say, look, don't freak out. I'm $1,000 a month just to show you an example of how this works. Then we can tweak this to the numbers that, that you prefer, right? All right, now right here, this means pay until year 100. Well, he's already 28. He ain't going to live till year 100. So age 65 is what I normally do because that's when people typically retire. I'll leave this alone. That's when they want to start taking an income. So if you do this on somebody younger, like a kid, and you're showing them that they're going to have like $200,000 a year when they're 65, I'd probably lower this, to like 50, 55. I'd rather get half that money earlier in life than to have to wait until I'm 65. I may not even make it 65. Here's the minimum not met death benefit. Does anybody know what that button does? All right, somebody tell me.
Makes it so that it won't mech.
It does make it so it won't mech, but what it does is it lowers the death benefit to the absolute minimum possible. So I do not usually check that. Here's the question, Jersey, is there any aspirations of you paying more later on in life, like increasing your contributions, or is like 1,000 the most you would ever put into it, period? If he says the most he's ever going to put in, then I'm going to check that button because that's going to give him the smallest death benefit and the most money in the future. If I don't check that button, it's going to give him the ability to almost double his payment. So I do that because I had a guy once say, I want to put a couple thousand in a month. Well, then like a year later, he calls me up, dude, business is booming. I'm liking my policy. I want to put another $2,000 in it. Well, you can't do that because it'll mech, right? So, but he can start a new one. Well, he had a mini stroke and he doesn't qualify. So by doing it this way, it leaves them room to be able to add additional income later. And I'll show you that in a minute.
Quick question for you.
Yes, ma'am.
I was under the assumption, let me know if it's a false assumption, that 30 days before and 30 days after your yearly review of said IULs, you have the ability to make adjustments to them.
You can, yeah.
Okay.
Yeah.
Cool.
There's a lot of adjustments you can make anytime too. They like the allocations. They can log in and change their payment method, their amount, their allocations, their beneficiaries. They can do all that from their own portal. Make sure they do not go changing the stock allocations if they don't know what they're doing. I just had somebody call me bragging, I switched everything to the BlackRock. And I'm like, what? They've been negative for 3 years. I mean, the average, the 20-year average is 3%. I had you in one that averages like 11. So anyway, we click that, we click the details button, we put in the money, and then leave that alone, death benefit option. All right, option A is level. There's nothing wrong with that. A level just means you're going to have a higher death benefit, usually about triple the death benefit, which means about triple the commission, triple how much money you make. That's not what most people want. Most people don't call you and say, I'm looking for a massive death benefit because I have a lot of people that depend on me when I die. I learned that in conversation. Like I said, this dude, he's got a wife and 8 daughters. If he dies, they're in trouble, right? He's the breadwinner. So yes, I am going to do a level for him. We've already talked about it, but I showed him both of them. I let him make that call. I didn't just pick one and just not tell him about the other. What I don't want to happen is they see another person's TikTok or Instagram or something video saying this policy has fees, and I didn't tell him about the fees, right? Or your policy set up level, and they don't know what that means, and then they look and there's is. So I want to I want to try to just get rid of all those questions and concerns right off the bat. B is increasing. And then if there is ever an option C, it's increasing to level. If there's ever an option C, that's what you want. So most companies are going to call it A, B, or C. Some will call it a return of premium here. Some call it optimal switching, Transamerica. And then some don't even have this option, Mutual Omaha. It's A or B only. So next thing we want to do is go, and you're done. You could technically stop right there, and you could technically, do the illustration. I like to turn on the charges and expense report so I can show them the fees. I wish it was just included on everybody's, but it's optional. And then I do this. What do you guys normally do for the stock allocations?
I usually do 50% in the 110 car, and then 50% in the S&P, whatever gives the highest.
That one?
Yeah, that one.
That's
I-
what Janine showed me to do too.
Yeah.
Yes, I was doing that last year. But the market's being tanked on purpose to fix the national deficit. So for now, I want to capitalize on bonus. So if I am going to use S&P, I was using this one because of the highest number, but I would have to use this one for the bonus because of the market going down. When the market goes back up, I'll show you this. Let me just load this and I'll show you. So I missed this. I meant to pick this option C. Somehow I accidentally hit tab or something and I went to option A. When you hit option C, it's going to open up this box. You want this to match what you put in the details right here. So whatever you put there, age 65, age 65, okay? Blow that up. So I like to start up here. I show people the interest crediting options and ask them, do you do any day trading? Do you know what any of this means? If you do, great. If not, great. Either way, it's okay. But one thing people always bash me on my TikTok videos is they're like, these things have caps. IULs have caps. And then they'll say that the same guy one day goes, don't listen to this guy, snake oil salesman, just put your money in the S&P 500. And I'm like, dude, we're putting money in the S&P. It's the same S&P 500. Your S&P 500 is not any different than my S&P 500. Only you can lose money and I can't. Right.
So you're going with the 1% bonus. That's what you said to do, right?
I put it all in this right here, and I'll show you why.
Oh, in the Morgan Stanley? Okay.
Yeah, I just meant whenever he was complaining about, IULs have caps, then he was saying, put all your money in the S&P. The S&Ps are the ones with caps. So the way a cap works, some of y'all already write these, and some of y'all are brand new, right? So I'm mixing up for everybody. But what a cap is, Jersey, I assume you're probably the newest we got, right?
Mm-hmm.
So a cap means that if the market does 20%, you're going to get 12%, but you're capped at 12, right? You can't make more than 12%. So
Right.
F&G in this case is going to keep the difference. Well, if the market does 50, you're getting 12. You see how a cap works?
Mm-hmm.
So none of these have a cap. That's because these are called volatility controlled indexes. In other words, F&G is the only one that has them. So think of it like a legal version of insider trading. They have a better grasp on what it can and probably will do because they're the only ones that have that stock.
Why the 1% bonus and not the one below it?
I'll show you. Let's say that you had a 401k and all you had invested in that 401k was the Morgan Stanley. In the last 20 years, a geometric average, which means this Morgan Stanley didn't exist 20 years ago, but if it did, running it through past historic data, this is what it would have done. You would have averaged 7.35% in your 401k. That's because 2022, COVID, we lost about 17%. 2008, housing crash, right? We lost about 19%. Well, if you just took that same money and put it over here in either one of these IULs, you would have gone from a 7% average to a 10 or 11.
Sheesh.
Yeah, because you simply can't lose money. So look right here. Your minimum guarantee on this policy, the contract says you can't make less than 0.25%. Well, this has a 1% bonus. So when the market's down, I want to capitalize on a bonus. In other words, my people are still earning money when everybody else is whining because they're losing. All right. Now, after a crash, we have an expansion, and that's where the market booms, massive, right? Usually big numbers. So this one got 21, this one's 20. I'll take it. That's great. But this one did 24. So in a down market, I want to be here. In an up market, I want to be here. Does that make sense?
Yep.
Mhm.
But like the guy that said, I just moved all my money to the BlackRock, when I was like, dude, look, like negative, it's supposedly on the rise, but the 20-year historic is only 3. You'd have done better in your 401k.
Wow.
Yeah.
So now that part's out of the way, I like to show the fees. Let's just go ahead and discuss and discard the fear of fees, because people that talk about fees don't understand fees. Charges and expenses. So first, this is policy. This is a premium expense charge. It's technically a fee in every life insurance policy. It's how they make some money. Cost of insurance. In IUL, the cost of insurance goes up and up and up every single year. So like for example, I mean, Jersey, look at this. If you pay just $600,000 permanent policy, you know how much that would cost roughly, right? It's more than $160 a year, isn't it?
Yep.
That's a stupid cheap discount on the actual insurance, so that more of your money can go, 1, in their pocket, and 2, towards growth. These are the other fees that people talk about. So I don't know what this is. This is the K-cups that go in their coffee machine. You know, it's the ink in their copier, toner, whatever it's called. Whatever. They can use on anything. They don't tell me that. They don't have to. So the total expense is the addition of those 3 columns, right? So I tell people, let me scare you for 1 second, Jersey. When you get ready to retire at age 65, that's when you should have about the highest fee you've ever seen in your life. At age 65, you make your last payment of $12,000. Your total that they're going to keep is $5,460. So basically, that's when people complain. They go, what? I paid them 12 grand, man. They kept half of it, just pocketed it, right? That's less money that I'm being able to invest. Jersey, do you see this column right here next to it? It says interest earned.
I do.
Do you think there's many people, because I know there's some, do you think there's many people out there that are dumb enough that wouldn't give me 5 grand if I gave them back 120?
Nah, I mean, it could be one person, but
You
think
find me
there's a
5
few,
grand
but-
every day if I was going to give you back 120 in return.
Pretty solid ROI.
Yeah.
Yeah.
I mean, you'd lie, cheat, steal, beg. You'd be like, Mama, check it out. If you loan me some money, I'll give you back twice your money, right? You'd make it happen. But look at this. Next year, would it be okay with you if we charge you a little less but pay you a whole lot more?
Yep.
I thought so. Now, here's where this is going to look not so great. So when people ask me, like, what's the age limit on an IUL? It's not that there's a limit. It's when is it not very beneficial? Because I had a 72-year-old man once, been studying IULs for a few months, been doing my homework. I'm ready to pull the trigger. All right. How much you want to contribute into your policy? I could swing about $50.
At 72, that's not going to get him much.
That's not going to get him a $10,000 final expense plan.
No.
It's definitely not going to be enough to cover the cost of insurance and have enough to grow money. And by the way, as we discussed last week, this account is really meant for retirement. You're 72. You're almost to the average age of death. You missed retirement. Sorry. But that's what I was thinking. I didn't say that out loud. But if I did, he'd have just laughed at me. But he was a cool dude. But yeah, I mean, if I ran this even at $1,000 for him, his fee would be, let's say, $14,000, and his interest earn might be, let's say, $16,000. So, I mean, did it work? He made $2 grand. It's not 121 grand, right? So it's not as sexy as it is if you start them younger, is what I'm saying. It'll still work. I mean, I know people that have averaged $2 grand in a 401k for 30, 40 years. So it's not that it's bad. It's just, right? The younger, the better. So now I like to show them that, look, that also, Jersey, I've never, now listen to the psychology hack, the seed I'm planting here. You're going to think, you ladies especially, are already going to know what I'm doing by this. All right, Jersey, now this is true. I pride myself on one thing. I have never lost a client except to death. I've never had someone call me and cancel. I've never had someone lapse one of these because they're flexible premium policies. I had a guy call me up during COVID. He's paying $1,000 a month. And he said, bro, check it out. I just lost my job. I'm so sorry. I know I've had this plan for like 6 months, but I'm gonna have to cancel it, dude. I can't afford that $1,000. And I said, well, do you think you could swing the minimum? He said, well, what do you mean? I said, well, remember we talked about the minimum. You've got a minimum payment. As long as you can swing $174, usually the minimum payment's about 20%-ish, of the planned premium. So Jersey planned to pay $1,000 a month, but if it hits the fan, whatever it is, it could be anything. Transmission blew up, COVID, he couldn't go to work, something. All you have to pay is this number. and you could pay that for 15 years. You wouldn't earn a lot of interest. You'd earn some, not a lot, but you wouldn't lapse your policy. You wouldn't lose all the money in your account. So I don't know if y'all know, I call this the double calculator trick. But when people say, you know, can I put more money into my account? Here's how you can tell. Y'all know where I'm going with this? No? All right. So Jersey plans to put in $1,000 a month. So times 12, right? 12 grand. Let's say Jersey's had this plan for 10 years, times 10. Jersey's put in $120,000. Jersey calls me up and says, hey man, business is booming. I got money in the bank. Can I add money to my policy? If you check that minimum no non-MEC button, you cannot put in more money. Like maybe 2 cents, but you know, because you're going to look at this number, the guideline annual. If you check that box, this is going to say 12,000 and maybe 2 cents or 4 cents, somewhere in that neighborhood. That means that's all you can put in a year. If you notice, I didn't check that box. Mine says 23,911.08. So here's how you do this. We do 23,911.08 times 10 years. Jersey could have put in 239,1080. He put in 120, subtract it. Jersey, you can put in a lump sum of $119,000 right now and not make your policy. Did y'all know that's how that worked?
Nope.
Pretty cool,
That's
huh?
nice. Yeah, that's
Awesome.
dope.
So what I just showed him is, you think about this, if things get tough, he can log in and lower his payment almost 80, roughly 85%. If business is booming and he's got extra money, he could double his payment the way I set it up. Right? All right. So now to the second part. This is the fun part.
Question.
Yes.
So how long, or how do you know how long they can pay that minimum payment without it lapsing? Does it
Good
tell
question. Good question. Very good question. So watch this. On this PDF, hit Control, hold down Control and hit F, and your search will pop up. And if you type in minimum premium, it'll take you to the definition page, and it says the monthly no lapse premium is the minimum required during the no lapse period to keep it in effect, and it tells me it's guaranteed until age 43. Do the math, it's 15 years every time.
Gotcha.
Yep, but good
Okay.
question. And before I forget, because I always forget to mention this, but these things also have living benefits built in. And one thing I love about this company is most carriers, you can only access about 25% of your death benefit. If you got cancer, heart attack, stroke, you can only access about 25. Here you can access 100% up to $1 million. So again, if you go to find and you put in critical illness, for example, it'll show you this rider gives the policy owner access to 100% of the death benefit not to exceed $1 million. And then it lists all the critical conditions. Right? Pretty neat. Other companies don't come close to that. So here's the fun part. And this is how I present it. Okay. So again, jump in if y'all have questions, comments, anything at all. So Jersey, first and foremost, this is a life insurance policy, not an investment. I am proud that this is not an investment. Let me just tell you, I've had people bash me on TikTok that say, this isn't a real investment. And I go, yes, thank God, because the word investment dictates risk is involved. These are based off guarantees. You can't lose money. Now they're going to ask you, they're going to keep asking you about this, can't lose money. What do you mean? The easiest way I've found to show people this is to draw it, because most people learn better visually. You can tell me something 10 times and I still might be a little slow and not get it. But if you show me something like in a drawing, with crayons, I'm good. So Heather, you can't answer because you've already seen this. But let's say the stock market goes up, it goes down, it goes back up. So right here, you have $100,000 in your account. Okay. The market crashes and we lose 50%. How much money do you have now?
50.
50, yeah.
All right. Now, the next year, after that crash, we just learned we usually have, sorry, that's okay. We usually have an expansion. That's where the market goes up. So just for even math, it goes up 50%. Now, how much money do you have?
75.
Very good, my man. So every time you do this with a client, they're going to say 100. And I mean, every time. I count.
Yeah.
Last year, 2 clients got that right. And I hired them. I was like, quit your job today. Come work with me. Because you've been brainwashed. This is how I prove to people, look, I'm not a conspiracy nut job, but you've been brainwashed by the feds. Because when the market crashes, you run your financial guy, girl, and you say, I'm losing money. And what do they say? Buddy, just ride it out. It'll be okay. It'll come back up. Right? Well, then next year you look and you see, okay, I lost 50%, but I got 50% back. So you think you washed. You think you're back to 100. What really happened is you had 100, you lost 50. That's now in the past. So I like to just draw X through that, and this helps people understand. Now I ask them the question again, and they get it right. Now let's start over. Jersey, you already got, but you understand. I'm saying if you are a client that got it wrong.
Yeah.
Jersey, you got 50 grand in the bank, and you just made 50%. So what's half of 50? 25.
25.
Add those together, 75, right? And then they go, oh, okay, yeah, you had to dig out of the hole to get to what we call the break-even point before you could even really earn any interest.
Mm-hmm.
All right, so here's how an IUL and technically a fixed index annuity are very much alike. Here's how they're different. When the market crashed, the IUL said, you know what? We're not playing that game. We're just not going to participate this year, right? We'll just take a 0. We'll take a loss. Or in other words, like I just showed you, you're going to get a 1.25. So again, I can't draw with my mouse because I'm left-handed, but let's pretend like that's a little slight upline that goes 1.25. All right, so I didn't lose any money. I still got my 100 grand, right?
Mm-hmm.
So when the market goes up 50%, I get 50% of 100. So now I have 150. When you put it like this, Jersey, do you want to have 150 or 75 when you're ready to retire?
I'd rather have 150 for sure.
Very good. Yeah, nobody ever says, I think I'd rather have 75. I just have to look. I'm like, you're not that bright, are you? So, and here's another good visual. If you've ever seen one of these, this is the stock market, or as I call it, the EKG. Like, we don't know what it's going to do. If you notice, I am trending it upwards. It is growing. The problem is if you are 30, let's face it, 30-year-olds don't usually have $1 million in their 401k. They might have 50. So if they have 50 and they lose half, they've got all this time to regain that 25 grand they lost. But if they're right here and they're, let's say, 60 and they want to retire in 5 years and they have $1 million and they lose half of it, then they don't have time to get back $500,000 in 5 years, which means their plans just changed. So the growth pattern on an IUL looks like this. Looks like a staircase. It can't go down. Now, my carpenter obviously can't measure because my stairs are uneven, but some years you gain more than others. But you're always going up, right? So good visual.
That's actually really awesome.
Well, thank you.
I appreciate that. Thank you.
First time a lady's ever said anything I did was awesome. So where were we? Let's see. All right. So Jersey, first and foremost, this is a life insurance policy. Okay. Your death benefit starts off at $634,179. That's weird. Jersey, you're a life insurance specialist at this point. You're learning this part, right? But for now, your final expense term. Yeah. Are you veterans?
Yep.
You doing okay? Good.
Yep.
Have you had anybody in the time you've been with us call you up and say, hey, bro, check it out. Talking with the wife last night. She told me we need some life insurance. We came up with a number. We're going to need $634,179 worth of coverage.
Never. Never
No
said
one
it.
is. I'd have to look at it and be like, how'd you come up with that? Did you use a math? Did you ask Chat GPT? Like, how'd you get that? So normally, and here's where I drive this point home. Normally, life insurance is a bill, right? When you pay a bill, you don't get that money back. AT&T, electric bill, right? You don't get that money back. You can't call up AT&T and be like, hey, I've been paying y'all for about 30 years. I've done the math. I paid y'all about $67,000. Listen, I need a new car. I'm gonna need about 18 grand. I just need a loan real quick. Can y'all send me some money? AT&T is gonna be like so confused, right? Because they're not a bank. They don't loan you money. They're a bill. They keep it all. When people call you for a life insurance policy, they're telling you how much coverage they want. That's an even number. Your computer is solving and giving them a price. That is an uneven number. So all that money is going to the insurance company and they're keeping it, right? That's a bill. You have to stop using the word premium and bill and stuff like that when you talk about these, because this is a bank. So this is not a bill. This is where you put money in a bank, which is called a deposit. So when you hear me talk about this, instead of contribution or investment, because that could probably get you in some trouble if it was taken out of context, you're investing money in something, but you can't call it an investment. So you could get in some tricky situations there. So don't use that word. So I like to use the word deposit. So watch this. Sherry, can I pick on you?
Please.
Okay, I read minds. Now, Esther knows I actually did have a car crash and I do have some little mind reading gifts, but not through a Zoom. But I am going to read your mind. So don't answer out loud. Just think your answers for me. I'm going to ask you the same question, but I'm going to word it differently. You ready? All right. Sherry, how much would you like to pay every month for life insurance? Now, she just thought, is that a trick question? As little as I have to, right? It's a bill. Okay, now here's the second version. Sherry, how much money do you want to deposit in your bank account every month? Now she just said, as much as I can, right? So that's where you have to get them thinking, right? They're already doing this. They just don't know it yet. And that's why I take so much time with education. If you're getting people on the phone right in the first meeting, trying to one call close an IUL, and you're saying, all right, Leanne, how much do you want to contribute? And they don't have a clue really what that means. They're like, $200. Is that enough? Is that good? And you just run it and you write it, right? If you would take time to show them that they're already doing this, let me show you what I mean. Go to my website. Here's a bunch of articles that you can use, a whole arsenal for factual data, right? This is from Forbes, arguably the most trusted resource on the planet. This is Roth IRA versus IUL. Or sorry, the IUL has 300% more benefits than the Roth. This is Forbes saying the IUL, the new 401k, right? Harbaugh, highest paid football coach in history, thanks to an IUL. But right here, how much BOLI do banks own? BOLI stands for bank-owned life insurance. Have y'all seen this? This is a report from the FDIC that shows you that currently 3,000 banks in America own $209 billion of life insurance assets. Leanne, do you use a bank or a credit union?
I use First Bank. It's part of PNC now.
Okay, we'll use PNC. PNC Bank is number 4. They own $11.4 billion of life insurance. So to be very clear, they're taking your deposits, buying life insurance, earning about 10% interest, no taxes, no penalties, no fees. Then they're giving you back 0.01 to 0.03 as a big thank you. I'm not saying banks are evil. They're a business. They've learned how to make money. All I'm saying is we should probably take a page out of their playbook and open our own bank, which is why we call this infinite banking. Technically, infinite banking, the way the Rockefellers did it, is a mutual whole life. We're going to teach that class probably in a week or two. But you can also infinite bank with an IUL. The only downside is that you should not touch the money in an IUL for a minimum of 5 years. So if they don't mind a minimum 5-year wait, IUL, at his age, hands down, is going to destroy the par whole life in terms of growth. But this shows people, I look up their bank and show them. They're like, well, I have a tiny town, I live in a town of 12,000 people. We probably don't have this. And I go, all right, First State Bank. There's my local bank. They own $84 million of life insurance. They only have 6 locations. When I showed this to them, they were trying to sell me an IRA, which is what I find hilarious because they put money in life insurance, but they're trying to sell you an IRA, right? 401k is 401k is an IRA, Jersey. So same thing, right? They're trying to sell me this, but they're putting my money in that. That's what they're investing in. So anyway, back to this. So Jersey, here's the death benefit, and here's how much you're putting in every year, $12,000. We're going to put that in until you're 65. At 65, you're going to call up the company and say, I'm ready to take distributions. And you can do this at any age. So God forbid you had a car crash or debilitating disease and you needed to retire at 45, you could. You would get less money, but you would still be okay. If I had to guess, if you took that at 45, it may drop to 80 grand, 70 grand, I don't know. But that's some money you might need in a pinch, So anyway, at 65, look at this, all zeros. You don't pay in anything else. So you've paid out $444,000. All right, now Jersey, what's your expiration date?
I don't know.
Exactly. All right, so James in your family, you're going to die, people in your family die in their 70s or 80s?
I would probably say in the late 80s.
Okay, good. That's already totaled for me, so we're using 88 anyway. So 444 is what you've put in. You've been paid out $4.2 million. You leave behind $706,000 to your family. So if we add that together, what is that? 4.789. Let's call it $5 million. We just turned $444,000 into $5 million. Here's where I lose people, Jersey. What was the average? I told you in the beginning that we're averaging on this particular setup. You remember?
You talking about the percentage?
Yeah.
Was it 11%?
Yeah, 10.3 or 11.3. Just kind of depends on which allocation. So let's just say 10, just to be safe. Okay. Right? Look at this. I ran this at 6. I am a firm believer in under promise, over deliver. I don't want to run this at such a high number and tell them they're going to have, 100 grand coming in every year. And then they get 99 and they're like, hey, where's my 1,000? Right, they're mad. I'd rather tell you it's going to be $183,000 a year as a tax-free annual income, and then it be double if I'm right. If I'm wrong, I still think turning 444 into 5 million is pretty good. I don't think anybody's going to be upset with that. But if it was 10 million, I think they just love me more, right? So we run this very low, conservative, ultra conservative. As a matter of fact, the national average is 8.67. This is 2.5 points less than the national average. And average means some companies are great and some suck. Well, F&G, look them up. They're always in the top 5. They're well above average. Now I show them how the bank works. Can anybody tell me off the top of their head how the bank works here? What I'm going with here? The cash value. How do I use the cash values? Anybody know how that works? Here's your account value. That's how much money you have in the bank.
Oh, it has to equal the same amount as the cash value in order for you to take out. Is that what you're talking about?
It doesn't have to, but there's no surrender charge if you wait until the 16th year. Yes, 10 years for most companies, 16 for this one. So what he's saying is there's a surrender charge. The surrender charge is the surrender and loans is what people are getting confused out there. Surrender means I don't want my policy anymore. Cancel this thing and send me my money back. This is how much money you would get back. And some of it would be taxed at that point. That's why I watch how I say 100% tax-free, because there's some caveats. They could do some things to screw this up and make it taxable, like cancel their plan. Anyway, your surrender fee is basically that minus that. But ultimately, that's what they would get if they were to surrender. But loans are a lot different. So the common misconception, and it's okay if you do say this because it's very close, but the easy way to explain it is this is how much is in your account, and this is how much is to loan, and this is the death benefit somebody gets when you die. That's the easy way. If you want the honest answer, how much can I use on the 5th year? Because you should wait 5 years, right? Now keep in mind, again, this is at 6, so I hope all these numbers are double, but 50,000 is how much it says you have access to. That's not exactly how much you could loan. If you want to know exactly how much you can loan, I can show you the math, but the easy thing to do is just go up one line and over to the left. That's the number you have access to the following year. I'm going to see if we can prove that mathematically. Go back into details. Let's see. In 5 years, you were 33. So I want to know how much money you can access at age 34. Okay, and the number that should pop up, if I'm right, is 54,831. What did I say? 34, 35,
33
for 1 year. And hit OK, and then simply hit calculate results. 33. Is that it? 54.
You put 35 in there.
No, did I?
Yeah.
I heard you say 33, and I just typed it wrong. But yeah, it is right. You're right. It is right there at 33. 54,831. Is that the same?
Yep.
4831. Yes, perfect. Yeah, so there you go. That's how you prove that. Just go in. I'll do this one more time so you can see this. Go into your details and change starting age to whatever age you want to look up, and then change the year to 1 to pay out for 1 year, and that'll show you what it is that they can actually access. So let's see. Let's put this back on 65 and 25. But any questions so far?
No, this is awesome.
Yeah, this is really great.
I'm going to steal your little diagram.
All right,
Right
cool.
out. That's
So
a great way to print out.
well, thanks. So anyway, ultimately what I'm looking at is at age 65, when he's ready to retire, he's got $1.7 million in the bank based on 6% only, right? And 2.3 million in death benefit based off 6%. So we have created an account that has produced that much income, and it's crazy. If you go listen to Tony Robbins, he has an old video where he says, so I told him, if you just put, he goes, you're how old, 24? If you put $300 a month away in an index account, do the math. With compounding interest, you'd have about $1 million when you're 65 years old. Well, we just did this for a 28-year-old with $1,000 in, and it's 1.7 million, and that's again on 6%. More than likely, that's going to be around $2.5–3 million. So from here, what I do is I tell them, I'm going to go ahead and email this to you, so I save it, and then here's what I do with it. Y'all can do this however you want, obviously, but this is just what I do. Oh, it's already up. Look at that. I did this for somebody last night. We'll just use his. So I send this to them. I send them the actual illustration, but then I also send them something of how to read it. And I say, all right, starting on page 11, you'll see the tabular details. And then I just make them like a little key. And I say, here's how to read this. Yellow is how much you deposit in the bank. Blue is how much you get in tax-free annual income. Green is how much money you have available to use in the bank. Red is death benefit that goes to someone when you die. Real easy. And then I'd say purple circle, just showing you that I use an ultra low conservative rate of 5.5. I send them this right here and tell them to look it over and let me know when they're ready. I don't, I always book my next call. That's another little gold nugget. Always book your next call. I don't care if it's an annual review. If you just wrote a policy and it's you're waiting for it to issue, you should be booking your next call with them probably a couple weeks later, because if it's not issued by then, you might have some pending issues. But when it issues, I'm booking a call with them. I'm showing them how to log in. I help them register. I show them how to change stock allocations. I show them how to change beneficiaries, how to check their account balance, like how to take loans, all that stuff. And then after that meeting, I say, all right, if you need me at all, you call me, but let's go ahead and schedule our annual review. We should be checking this every year to make sure it's doing what you need it to do and it's performing right. Always book your next call.
It's a lot of
That's actually
appointments.
smart, because then they're going to pass their warm market to you.
Yep. I always ask if they have kids too. Do y'all know why?
I have paths that are set up for both my kids.
Yes, good. So the reason you want to do this for a kid, watch this. I say, all right, Jersey, I'm going to change you. Do you have kids? You don't have kids, do you?
I got 6.
You have 6 kids?
No, I'm just kidding. I ain't got no kids.
I was like, you look way too young and healthy to have that many kids, bro.
like,
man.
not yet. Not
You
yet.
got too much hair for 6 kids. All right, so let's just say he has a 6-year-old son. I don't need to put $1,000 in on a 6-year-old. So Jersey, how much you love your kid? $50 a month or $100 a month?
Let's start with 50.
All
I feel like most people would say $50 probably.
Yeah.
But of course they would want to do 100, but let's do 50.
Yeah, depends on how many kids they got.
Yeah, very true.
All right, I'm leaving everything else the same, but I'm going to view this again and I'm going to compare it. So what I'm looking for to compare is I'm betting that Jersey's son putting $50 a month in because he's younger is still going to have a nice reason. He's probably not going to beat Jersey because Jersey's young and he's putting in 1,000, right? But what I'm looking at really is this number. How much is Jersey getting in retirement? How much is kid getting in retirement? And the kid, Jersey's 183. His son's is 38,000. So 38 is what $50 a month gets you if you're 8 years old. But that right there is still powerful. When you show them, look, when your kid turns 30 and he just got married, he wants to buy his first house, and he goes, hey, Daddy, can I borrow some money? I ain't got no credit, man. I need a cosigner. I need a down payment. Look, you can just go pull money out of his account. He's got 40 to 80 grand. Like when you show this from a parent perspective, see, people think life insurance sounds morbid. They don't want to talk about life insurance on their kid because it sounds morbid. But we're not doing this for that. We're not doing it so you make money off your kid when they die. This is this is how I start the conversation. Jersey, imagine starting 3 401ks on your son right now.
Mm-hmm.
Like, what's his retirement going to look like? You ever heard of the Rockefellers? You know what
Yeah.
generational wealth means? It can all
Mhm.
start with you, right? People tell me their story, man. I'm struggling. I'm paycheck to paycheck. Everybody in my family's broke. I got one right. I'm working on it right now like that. And I mean, he's in his 50s. At his age, he probably need to put in $500 a month minimum to make it, look good. And he can't. But he's got a 12-year-old and he can swing about $100 a month. I'm like, man, you'd be better served to go ahead and put that money in your kid's policy, because less of that money is going to go towards fees. He's young. He has more time to grow money. You own the account. You control the money. He can't just cash it out when he's 16, go buy a jet ski, because they'll do that. So, you own it. You're the beneficiary. There's 4 parties involved. You own it. You're the beneficiary and you're the payer. Kid is the person you covered. So this money is still yours. At some point in life, you're going to explain this policy to your kid. The kid's probably going to take over and, pay for it on his own. And then they go, well, yeah, but what if I die? Okay, well, let's say you die down here when your son is 45 and you're 60 something. I don't know. Your kid's got $223,000 in the bank. Your kid now inherits this account. Your kid can log in and pull a loan out of that, and he can pay you. Speaking of loans, I forgot that part. If y'all have an extra 2 minutes here, I'll explain loans. So when you do pull that money out, and I'm just going to use this number, even though we know it's that, right? So let's just say right here, $100,000. I want to go buy a sports car, $100,000 car. right? So forget taxes and all that stuff. But there's 3 loan types. Variable, even though that's not common to like a variable. Variable is the loan type that you would prefer to use because their variable interest rate has a cap of 5%. They can't charge you more than 5%, okay? Which means the money that you take out is being charged 5%, which means you're earning 5% on the money that's in your account. You pull 100,000 out and you buy a car, and let's just say that, I don't know, 10 years later, you have a stroke and you pass away, or you crash the car and you die. So what's 10 years right here? Sorry. So in 10 years, I need volunteers, and I'm going to use, who else still here? Sherry and Leanne. Okay. Both of y'all, hopefully your husbands aren't listening. Both of y'all are my sister wives. I want you to answer me honestly. Now, here's how the loan works. All right. If I make a payment to myself, I'm actually earning interest on money that I pay back to myself because I'm the bank. I loan me money. I'm paying myself back. I earn interest off of the loan payment back to myself. I don't have an amortization chart. I can pay $20 a month for that Corvette. I can pay $5,000 a month for the Corvette, or I don't ever have to make a payment. So I want to pay it off because the sooner I pay that loan off, the sooner I can use that exact same 100,000 and go buy a boat or a business or whatever, right? Property to flip. But let's say I never paid it off and I die at 47. Damn, that sucks. I'm 47. All right. You ladies are supposed to split $1 million. But I never made a car payment. So you're going to get a letter and it says, we're sorry your husband died. You're supposed to get $1,017,224, but he never made a payment on the car. So we deducted the 100,000 because this is the collateral. So you ladies are only going to get $900,000. Are y'all mad at me?
Yeah, I want to know how he got away with 10 years not paying on that car without getting it repossessed.
So that's the question. My real policy that I started at $500,000. It's very close to this. And by the time I die, it's worth about $3.5 million. So do you really think my wife's going to be mad at me that she only got $3.4 million?
No.
In the meantime, I use that account to buy the beach house, the boat, the jet skis, the cars, the rental properties, the houses we flipped, the businesses I've bought. Like, you know what I mean? And by the way, use it smart first, right? Get income producing assets before you go buy them supercars. Okay?
All right.
I have one question.
Yes, ma'am.
Excuse me. Rule of thumb, what we've kind of been taught is don't do an IUL on someone over 50, 55. What are your thoughts on that?
Good question. So an IUL can be structured a lot of different ways. I just ran a comparison on a par whole life. Do you all have those? Are you doing those? That's what I call infinite banks, Forsters. So if I run the comparison, right, 1,000 into both, and I'm usually surprised. Usually about 55 is that's just the number I made up. But I've noticed about 55, the IUL is not as attractive as the par whole life. Now, I ran one the other day on a 57-year-old, and I was amazed. The IUL actually had about $150,000 more in it than the par whole life. Here's the deciding factor. When do you want to use the money? Because par whole life, you can use it tomorrow. IUL, 5-year minimum. So if they want to put in 100,000 and take out 100,000 tomorrow to buy a property to flip, that's not an IUL. That's an infinite bank. If they don't mind putting it in there and letting it grow, IUL, if they're under 55, is probably the hands down winner.
Okay, so for me at 60, is that even something I should consider, or do you think the par whole life is better?
So again, it depends. If touching the money, 5-year wait, touch the money is not an issue, let's throw that out the window. Then what I would do is run a comparison between the two. It really depends on how much money you're putting into it. Good example, 63-year-old. I give it to one of my agents. She calls her up. She's brand new. I said, here, ask her these 18 questions. She calls me back. The lady wants to meet with you. I said, okay, what's going on? She said, well, I asked her how much she want to put in it. She said $10,000 to start and $1,000 a month. And she said she was actually impressed with the numbers. I looked at the numbers and it paid her $6,000 a year. I said, she's impressed by that? I got to meet this lady. So I get on the call and the lady's like, yeah, everybody else I talked to is like 2,000 or 3,000. So your all's is a lot higher. And I was like, okay. She said, but I still couldn't live off that. How do I get that number up in the 6-figure range? I said, easy. Add some 6-figure money. I was just joking. She goes, put me down for 600,000 and I'll put $10,000 a month in. Now the IUL works because you're outpacing all the fees and the rising cost of insurance. So It's not a yes or no question.
Yeah.
But the other way you could set it up for someone, let's say in their 60s, is as a death benefit. You can structure it in a way that it doesn't grow cash, but it gives them a cheaper final expense. If Jersey showed you a final expense policy and it was $400 a month, and you wrote the exact same policy in an IUL and guaranteed it to 100, he can't do that. His guarantees to 119 or 121, depending on the company, which means you're paying for those extra 20 years that you're not going to be alive, because people don't make it past 100 typically, right? That's why I ask him, when do people die in your family? If they say, hell, everybody's gone by 70s, all right, well, let's cover you until 100, 110 to be safe. So I just knocked off several years of payments, which lowers the price. So you wrote him a 50,000 Jersey, and it was $400 a month. I wrote him a 400,000. What was I saying? I wrote the $50,000 policy, and instead of 400 a month, it was like maybe 310, a little less, a little cheaper. So there's lots of ways you can structure these.
Okay. Thank you.
You got it.
Shannon, you're brilliant. Thank you so much.
Yeah. This is
Listen,
amazing.
in 3 weeks, we're going to tie it all together by asking the golden question. And then I'm going to show you how you're going to find annuity opportunities by all the clients you're currently talking to. And I'm going to show you how to do what I just did. So I just took somebody that has $2 million in a 401k. We're going to roll that. You can't roll it into life insurance, right? Because their 401k is qualified money, and life insurance is not taxable, non-qualified. So I have to roll it into an annuity that's qualified. So $2 million rolled into a certain carrier that I kind of like gives them a 27% immediate cash bonus. So times 1.27, that's $540,000 that they get in bonus money. Just to sign up with us, sir, we're going to give you $500,000. How's that sound? That sounds great. Let's do it. So now they have access to pull 10% out of their account day one. So they can withdraw for free $254,000. And that's what I put into the Infinite Bank or the IUL. And now they don't have a premium payment.
Yeah.
Yeah,
Yeah.
that'd be dope.
So
This is what we need to learn, how to determine what's best for the customer and create those types of policies rather than just learning how to talk to somebody on the phone.
yeah.
Well, and like this is hands down like the best training that I've had in the last year and a half
Yeah.
solid.
Yeah.
Well, thank you. And